All right, welcome back to the Dynamic Growth Podcast. My name is Nate Crosby, and on this podcast, we talk about strategies and concepts for wealth accumulation, business growth, and wealth protection. Today on the show, I've got Derek Ballinger, and we're going to do a short interview here. Derek has passed the Level 2 CFA, and he is the chief architect behind Crosby Advisory's investment models. Derek, how are you doing today?
Doing pretty good. We're recording on the morning of the 3rd, so the market's not doing great, but I'm doing great.
I was actually thinking that based on the topic of our podcast today, this is actually the perfect day to do that. As we look at the market, we've got different sectors acting very differently to the news of the tariffs. Tech sector is getting hit very, very hard. Healthcare, consumer staples, utilities are faring a bit better. So this will be a brief interview, Derek. I wanted to interview you on this because I think there's a lot of interesting information that investors, whether they are do-it-yourself investors or if they work with an advisor, can take when they're looking at building and constructing a portfolio to achieve the goals. And a little brief background for those of you who are not familiar with Crosby Advisory models. I would say most of our clients are in what we call risk-based models, and the risk-based model essentially allows the investor to select an acceptable level of volatility that they are willing to assume for the long-term growth of their account. And those risk-based models range anywhere from ultra conservative, which might have essentially no volatility with treasury bills or money markets, from conservative to moderate all the way up to aggressive. And what we find obviously is long-term, viewed over decades, the more volatility that we are willing to assume, generally that leads to longer term growth. But it's important that the investor is able to stay in the strategy during good times and bad. And obviously, to your point, Derek, we're seeing that today where the market is having a bit of a sell-off. So if we have a client in a model that is too aggressive, keeping them up at night, that's not what we're here to do. We're here to create portfolios and strategies that enhance their life, not create stress. So one of the things we talked about in our last investment meeting is we talked about the possibility that factor investing could play a larger role in the implementation and the adjustments of our risk-based models. Derek, for our listeners in as plain English as possible, what is factor investing?
So I've never really been good at plain English, so I'm probably going to give you like a 5-minute diatribe, so I apologize in advance. But factor investing, a good place to start explaining it is if you're a somewhat novice investor, you're probably familiar with the concept of beta. Beta is, you can measure beta against a stock or like an ETF mutual fund. It basically attempts to look at how much of the variance in the stock or ETF or mutual fund is explained by movements in the overall market. So if you look at a stock that has a beta of 1, maybe like ticker SPY that just tracks the market, that's basically saying 100% of the variance in SPY is explained by just broader movements in the market. And if a stock has a beta of 0.5, that means if the market's up 1%, that's going to be that stock's going to be up 0.5%. And if the market's down 2%, that stock's probably going to be down 1% on average, holding all else equal. And then you can kind of take it a step further and say like how good is the explanatory power of the variance of the market on this particular stock. Sometimes it explains it really well. So like with SPY, it's going to basically be 1-to-1. It's going to have basically all of the explanatory power is from that one factor, which is the market factor. But then some other stocks, maybe we could look at like NVIDIA or something. It might have a beta of closer to 2, but the market factor doesn't really do a good job at explaining it. Like you see on some days, the market's up and NVIDIA's down and vice versa. So what we can do, the reason for that is because there's a lot of things that drive returns and there's a lot of things that drive risk, not just the market factor. So when you only look at one variable and try to explain the variance, you're going to basically like miss out on a lot of the stuff that actually drives risk and returns. So you can introduce other variables to try to better fill out the explanatory power. the way you can think about it, if you're familiar with statistics, is it's called omitted variable bias, which basically is like if you're trying to determine how much of A causes B, that if you just run the analysis on those two variables, it's going to give you a number just because of the way the analysis is run, but that doesn't necessarily give you like predictive power for the future on if A actually causes B. But maybe there's a variable C that explains B a lot better. But if you don't include C, it's basically going to give all that explanatory power to A just because you ran the analysis that way. So if you run does A and C cause B, then it's going to give you a much higher like better fit to the data, and that actually gives you some explanatory power and predictive power of what the future might look like. So that's what we're doing with factor analysis. Factor analysis, you're basically just adding or introducing more independent variables to try to explain the dependent variable, which is the variance in the stock or ETF or mutual fund that you're looking at.
How many times have you ever gotten the question, why is the market up or down today?
Yeah, right. That's a good point. And the answer is typically, I mean, sometimes you might know, like today, obviously, the answer is very clear why the market's down with the tariffs and stuff. But on any given day, like, there might be no news and the market's down or the market's up, and there's not really a rhyme or reason for it.
So let's talk about a few factors. What are some common factors that investors would look at? Yeah,
so there's I think it's the Fama French model. It's typically like the pioneer of of factor investing. I believe that looks at 5 factors, but the ones when I run the analysis with our models, the factors that I look at are size, value, momentum, quality, and investment. And the investment factor is basically just are they reinvesting into the business? Are they growing their asset base? And actually, it's pretty unintuitive. Companies that reinvest back into their business and build their asset base more than companies that kind of aren't as aggressive. Actually, the companies that aren't as aggressive outperform the companies that are very aggressive in building the asset base. When I was running the analysis and like the actual performance of these factors, that's one of the things that surprised me. I didn't expect to see that. And I don't think many people would expect to see that. You would think that if you're constantly reinvesting into the business, those companies would have higher returns, but that's not true.
Yeah, they're very interesting. So when you say quality, what are we actually referring to?
Quality is basically like high profitability. You're looking at operating income, operating profitability. That's companies with higher. So operating profit is not just like cost of goods sold. It's not like what it costs to get something out the door. It includes like your marketing costs, your sales costs, and all that stuff. But it doesn't include things like interest and taxes and stuff.
Interesting. What about momentum?
So momentum is basically, let's look at the past trailing 12 months of returns. Companies with very high trailing 12-month returns are more likely to just continue doing that. Those are going to outperform the companies that had negative trailing 12-month returns, for instance. And then, I mean, that works against you as well. So like the companies that are high momentum, those are more likely to, those will have worse returns in a down market just for the fact that they've just had trailing 12-month returns. It's basically like the status quo will continue type deal. That's kind of what momentum looks at.
Well, that would make sense if you've got a stock with that it has run for 12 months and likely has grown. So we might see an elevated PE in that stock. So when things start to get go south, they're probably going to get a bigger haircut than something that maybe hasn't run up as much.
Yeah, right. And so some companies are just completely not exposed to that factor at all. So let's talk about momentum in particular. Like obviously companies like Palantir or Nvidia or Eli Lilly, those are, at least in this market cycle, they're very exposed to that momentum factor. A lot of the returns, at least in the past, like let's say 6 months or so, are largely driven by momentum. Not necessarily. Those are all really good businesses and they have grown earnings, but a lot of it is just driven by the fact that they're up so much and they're going to continue to just continue to go up. And then when the momentum breaks down, and let's say this market does eventually, let's say this correction turns into something a bit deeper, you would expect those companies to sell off more than the broader market, just because they have more exposure to that momentum factor.
In a bull market, for our listeners that don't know what that is, that's a rising market. Are there any factors that have, at least historically, proven to have the ability to outperform, say, the S&P 500 or index return?
Sure. So a lot of it's pretty intuitive. So like when I ran the time series over the past 20 years, and actually all of the factors had like a positive expected return. Like all of the factors contributed to basically like positive growth. And if you look at like a chart of the S&P 500, for instance, it's up and to the right. So I mean that's that makes a lot of sense. But not all bull markets are the same. So if you look at like very, very long time series, like the past 50 years or so, you would expect small cap to outperform large cap, and you would expect high profitability to outperform low profitability, and you would actually expect value to outperform growth. But I mean, if you look at the post 2020 bull market, let's call it that, excluding 2022, small caps have dramatically underperformed. Growth has outperformed value. I would say high profitability outperformed low profitability. But when you're running this analysis on like many decades, it's basically you're looking at on average what you could expect to happen, not necessarily like this is tried and true for every single market environment, and things behave differently. But I'd say in general, you would expect small to outperform large, high profitability to outperform low profitability, and value to outperform growth.
So in the beginning of this podcast, you talked about the difficulty of looking at one variable and explaining why something happens. So you had just brought up when you said that not every bull market is the same. I mean, there is one of the reasons why this job is so hard is that we're looking at the past and trying to figure out what the likely probability is of the future. But to your point, not every bear market's the same. Not every bull market's the same.
Yeah, sure. And then I'll also add momentum typically does outperform in bull markets, and it would dramatically underperform in bear markets. But to that point you made in particular, another thing you can use factor investing for, like in particular, is you kind of have to know where you are to basically like tilt your portfolio in specific ways. So you can use these factors to basically implement their capital market expectations, which is basically like your short, medium, and long-term view on stocks. So if you don't know if you have any exposure to the momentum factor, and like let's say you had a really good 2024, you could look at your portfolio and you're like, yay, more of the same. I'm going to own all this stuff. But all of those returns may have just been driven by the momentum factor. And if you expect 2025 to be worse than 2024, that's probably when you would want to start making changes to the portfolio. But if you don't know, all you see is, positive return in 2024. And that's true for all the factors. You do that for small cap and value and quality as well.
We've seen that, in the past years, like ARK investment, right? Or the ARK ETF, the innovator disruptor, right? I mean, that had years where it was, I think one year it was up like 150%. And, people piled into that. And then we obviously saw it get creamed when things went south.
Yeah, that's a perfect example. Like everyone would, Forbes wrote the article about Cathie Wood being the new Warren Buffett. It's not that she was the new Warren Buffett. It's just that she was hyper exposed to the momentum factor is kind of how you can think about that.
Yeah. So let's talk about bear markets. You've named, we talked about momentum. Are there any factors that tend to outperform in bear markets, understanding that not every bear market's the same?
Yeah, I mean, so an interesting one is value. So when I say the value factor, it's not a subjective judgment of like it's good bang for your buck. We're literally just talking about like low price to book or low price to earnings companies. And some of those might be cheap for a reason. So there is an element of like active management. So if you're really good at identifying value, you could expect those to outperform in a bear market. So that one's kind of mixed. It just depends what companies you actually own that are exposed to that factor. And then obviously the market factor is kind of just, it is what it is. That's kind of your benchmark of what you would be comparing it against. But I mean, yeah, you would expect momentum to underperform. You would expect quality to outperform in that environment as well. Just because, I mean, if the market's going down, you don't want to own unprofitable companies. You want to own companies that become more and more profitable every year. And then small cap, I would probably expect, I don't have the numbers in front of me, but small cap I would probably expect to underperform as well, just because in a negative environment, they're more sensitive to negative news, just because you think of a company like Apple or Microsoft or Amazon, they just have so much inertia that, I mean, even if the economy is bad, they're still probably going to grow and make money.
Makes sense. So when we look at factor investing, what essentially investors are doing is they're looking at ways that they can tilt their portfolio or add a little bit more weight or a little bit less weight into different factors. Are there any metrics or data sets that investors could look at when deciding? So you made the point, it's important to know where you are, right? You have to know where you are in the cycle. Is there data sets that people can look at to try to figure out if they should be in momentum, if they should be in value, if they should be in vary the size of their accounts? Where can they go to get that?
Yeah, so I mean, it's basically expressing your market expectations. I mean, that's kind of the job. I mean, if you think, I mean, everybody can look at all of the aggregate economic data that everybody has and can come to wildly different conclusions. So, I mean, there is an element of, your subjective eyes looking at the data. But as far as like how the actual data is compiled, like so when you're running like the regression analysis is what it's called. Like where do you get the data sets for small minus big and high profitability minus low profitability? Basically what you would do is you would take basically every single stock that trades on the New York Stock Exchange, the NASDAQ, et cetera, and you literally just rank them from smallest to largest, and then you take the median company, so the middest cap, I guess is how you could look at it, and then anything smaller than that is classified as small cap. Anything larger than that is classified as a large cap, and you're basically going long the small portfolio and short the large portfolio. And the reason you go long and short is because you want to be market neutral. You don't want, if you just went long the small portfolio, some of that performance is going to be attributed to the market factor. So you're trying to be market neutral so that any output that comes from this analysis is basically isolated to that size factor, what you're trying to look at. And then that basically you can think of it as a portfolio in itself. You're long the small cap, short the large cap. That's going to have a return series of itself. And then you basically look at how much of the variance of your portfolio is explained by the variance in that data set that you just compiled there.
So I know this interview is running actually a little bit longer than I expected, and I know that you're a busy guy today with what's going on in the market today. So I'm going to wrap this up with a final question. So factor investing, for somebody who does this for a living, factor investing is very interesting, and we're always looking for ways to get an edge in the portfolio, right? Ideally, if we can outperform in good times and we can lose less in down times, that gives us the edge, and that's exactly what we want as investors. For the rank and file investor, the retail investor, do you think that there is a place for factor investing, or in your opinion, should they just capture beta through the S&P 500 or other indexes and ride the ups and downs?
So I think it's you have to make that judgment factor by factor. I am of the belief, and this is how I invest personally, I think retail investors want exposure to the market factor first and foremost. And they also want exposure to the quality factor. Just if you look at like the long-term trend, the stock market is basically rigged to go up because populations grow, companies scale, they become more profitable, economies of scale, all that good stuff. Companies become more efficient in their operations. You want to own the companies that get better and better and better every year. And we always point to like Visa as the classic example. I mean, ever since they went public, basically all of their internal metrics have done nothing but get better every single year. You want to own companies like that. And even if you have to pay a little bit more for those, it's still probably worth it to own those rather than like that's basically a comment on the value factor. I don't necessarily think you have to be exposed to the value factor for retail investors. Just because it's cheap doesn't mean that it's not cheap for a reason. You want to own good companies, and even if they're expensive, if they continue to grow earnings, hopefully, I mean, I'm kind of generalizing here, but if something's like egregiously expensive, then don't own that. But in general, you want to basically capture the upward trend of the market because the stock market's rigged to go up, and you want to own companies that get more and more profitable and return value to shareholders. And then I would make a comment about small caps as well. I wouldn't necessarily just buy the Russell 2000, for instance, which is like an index of small caps. You probably want some element of active management if you own small caps, just because you're basically paying somebody to follow all of the company-specific risk in these companies that you're not necessarily going to follow every day. People that are, going to do a better job than you. If you have a full-time job, you're not going to be like digging into balance sheets on all these tiny companies. So if you wanted exposure to that factor, which has shown that it outperforms over the long term, I would probably skew towards active management, but I think that probably has a place too. But use your own judgment on if you think you're good at evaluating those types of companies.
All right. Excellent. Hey, Derek, thanks for your time.
Yeah, good to do this again. It's been a while. Sorry, I'm a little out of practice, but yeah, we'll get back into it.
All right. Well, take care.